I think it goes back to one of the key differences in the Australian market versus the US market and the European market, and that's that institutional participation is very, very low in leveraged finance markets in this part of the world. And institutional lenders are natural providers of mezzanine debt. It's more difficult for banks to do it. It doesn't sit on their balance sheet well. They get penalized quite heavily from a Basel capital adequacy point of view. However, nevertheless, a lot of banks up until pretty recently were mezzanine debt providers. But the biggest mezzanine debt providers in the markets locally were still institutions. I think going forward, what you will see is you will see more and more global players coming down to Australia. We've already seen it. There are a lot of European names here already. There are some American names coming down here. But as a prelude to that, what's going to happen is the Australian mezzanine debt market is going to have to internationalize. It's going to have to globalize. The way that mezzanine debt gets done here needs to be much more similar to the US and the European markets, and traditionally it hasn't been. Most of the activity that we're seeing is on the refinancing front, or recapitalization front. And in fact, a lot of our competition right now is the IPO market, where you might have a company that has too much senior debt, and they have a senior debt lender who's lost patience with them. They need to pay down their senior debt. Where do they go get capital? Well, the first answer should be mezzanine debt, but mezzanine debt's probably become a little bit more secretive now, or at least the providers of it has probably become a little less obvious, because while it was always a small industry, there are a number of players who've fallen by the wayside and are no longer investing in the market. And I think that's probably where we're going to see most of our activity for the next 2 years. It will be refinancings, where you've got financiers who've gotten themselves in trouble and need to exit the mezzanine debt market. Will be replacement capital for them. And also it's people who want that little bit of expansion capital but don't want to inject the equity, or they can't. And even for non-sponsor deals, it's corporates who feel they have no other alternative but to raise money on public markets to pay down their senior debt financiers. Those are all opportunities for us. So we work very hard on making sure that we've got a deep and active pipeline. And frankly, the hit rate for us, it probably is about 1 in 10. We will look at 10 different transactions, and within that pool, there might be 2 where we sort of go, absolutely not. There might be another 3 where we go, yeah, maybe if I can get the right terms and it's the right sponsor. And then hopefully after that, the remaining 5 are ones where we all go, these are all really good, but which one's the best? Where is there a sponsor we like more that has a good reputation? Where is there a transaction where the asset backing and the cash flow is just at an absolute elite level? Or where is there just a situation where someone's doing a very good deal?